Cathie Wood, CEO and CIO of investment firm ARK Invest, is predicting a collapse in the value of automotive companies. While ARK's investment funds have been hit hard over the past year, there have proven to be many believers in Cathie Wood's long-term strategy. In May, for instance, the flagship ARK Innovation Fund received a staggering $658 million in net inflows. Many of ARK Invest stocks are valued on earnings multiple years into the future, but in today's environment, investors are more concerned about the present. However, one of Cathie Wood's best picks of all time has been Tesla. Betting on Elon Musk has been the right move, and their insane growth predictions from 4 years ago have been surprisingly quite accurate, if not even too conservative. Back in 2018, they very publicly bet that Tesla would more than 10x to $4,000 per share by 2023. And Tesla has in fact hit this at the time insane price target years earlier than expected, though ARK Invest has on occasion been selling Tesla in order to follow the fund's rules and keep the holdings below 10%, while putting the money into other companies, many of which have been underperforming. But even with the recent sell-off in 2022, Tesla has come back with a vengeance and still holds the top position in ARK's innovation fund. And by the way, stop using Yahoo Finance, stop using Google Finance, and have a look at our website, themarketisopen.com, where we have instant stock quotes and financial data going back 10 years, and it's all freely available. Now, many of Cathie Wood's holdings have been hurt in multiple ways by inflation. Inflation has increased the raw costs that go into products, which has triggered many companies to raise prices. While some can more easily pass on price increases to consumers, others cannot and could see declining sales meeting these increasing costs, which is a recipe for disaster. At the same time, governments are doing their best to curb inflation by increasing interest rates, which act as gravity on the value of stocks, especially those with long time horizons before they have meaningful profit. ARK Invest time horizon is typically 5 years out, which means their strategy of picking growth companies with high earnings multiples can be highly volatile in the face of changing interest rates, and it could take years for ARK Invest's 5-year targets to come to fruition, assuming Cathie Wood and team are correct. Tech stocks have been in a bear market for at least a year already since the middle of 2021, but Cathie Wood is starting to see some helpful signs of easing, especially on the inflation front. Back in March, Tesla CEO Elon Musk said that Tesla and SpaceX were both seeing significant inflation pressure in raw materials and logistics, likely including the cost of shipping, for which Tesla has a fleet of vans, trucks, and uses boats as well to bring service and vehicle deliveries to customers. But just recently, Elon Musk says that inflation might be trending down as more Tesla input commodity prices are moving down rather than up. While people immediately think that Tesla will be lowering their prices if this occurs, it may actually have a broader impact on giving a wide range of businesses and consumers some breathing room, as well as confidence that inflation levels and therefore interest rate increases could be peaking and slowing down. Tesla is an economic bellwether given their vast amount of business and raw material usage to build cars in the US, China, and now Germany that they use, and Elon Musk sees real-time data from Tesla's operations, which have likely helped him and the team make quite accurate predictions. One interesting thing is that Tesla has been trying to forecast their future cost increases and raise prices on their vehicles to try to match up and level out the impact to their business. If someone purchases a vehicle today that will only get delivered in 6 months from now, given Tesla's massive backlog, then today's prices need to match future input costs to build that vehicle, which is a challenging task. On the flip side, as costs start to come down, Tesla could lower their prices, however we haven't seen that happening yet. More importantly, Tesla could actually be making a much higher profit as their costs come down, but their prices still remain high. At the same time, in the most recent quarter, Tesla was held back by shutdowns in China, and so their production, although very impressive at 250,000 cars, was affected globally, since even their other factories in the US and Berlin are dependent on components from China. And so if we combine this information together with the knowledge that Tesla's backlog of car deliveries has lately been in a sense a staircase of increasing prices since Tesla has raised their price multiple times in the last year, then in the upcoming quarters, if we can finally see Tesla's uninterrupted delivery and production capacity, then essentially as they complete these earlier lower priced orders, thus working through the backlog, then Tesla's average selling prices from an investment standpoint will continue to move higher, even if Tesla has stopped raising prices on consumers. So the more cars they deliver, the higher the average selling price will be in their financials, because a higher percentage of cars sold will be from those locked in at those increased prices. Tesla has capacity of close to 1.9 million cars now, and while they're not producing at their capacity yet, if they can post a record delivery number, then perhaps they can burn through their lower priced orders and start delivering these higher priced orders both sooner than their commodity prices have increased, and catch up on their backlog in order to sell more vehicles at the current high price, even if commodity prices and other inflationary forces have begun cooling down. Moreover, in a research piece by Sam Corris of ARK Invest, he sees lower cost lithium iron phosphate batteries taking much more market share of electric vehicles than previously believed. There are two main types of batteries for electric vehicles: NMC batteries, which contain expensive nickel and cobalt, and lithium iron phosphate batteries. The latter are less expensive today and are on course for faster cost declines. This could over time put further downward pressure on costs, which is one of the reasons why Cathie Wood thinks we may even see some deflation over the coming years. According to the research note, these cost declines are a result of achieving the production necessary to hit a cumulative doubling of LFP-based EVs. LFP batteries need approximately 7 million units in order to double, one-third that of the approximately 20 million necessary for NMC-based EVs in order to realize that drop in costs. On top of that, ARK predicts that LFP batteries will reach a 47% market share by 2026, meaning that they're poised to grow even faster than NMC batteries, leading to more rapid cost declines over time. And surprisingly, LFP batteries already hold an approximately 33% market share in EVs. So LFP batteries are not just growing quickly relative to other battery technologies, but they're also growing in tandem with the rapidly expanding EV market. And this is in line with Elon Musk's comments over the years that LFP batteries will be heavily used over time. And so ARK Invest could be right that massive cost declines may be on the way, especially as Tesla continues to ramp up production of electric vehicles and even their own batteries, which may use LFP chemistry, further accelerating this cumulative doubling cost decline trend. But this brings us full circle to ARK Invest's forecast that there could be a collapse in the auto industry valuations, even if the number of units sold increases. First off, it's not just high multiple growth stocks that are seeing commodity pressures. Legacy auto companies have been hit hard by commodity increases as well as chip shortages which have reduced their volumes. These companies have been able to capitalize on the combined woes of their peers by increasing prices. But as Cathie Wood notes in her most recent In the Know podcast, even with supply chain disruptions, there is indeed demand destruction occurring. For ICE cars, either the consumer can't pay for gas or won't pay for the gas. At the same time, gas-powered vehicle sales have continued to decline or shown almost no growth, while electric vehicle sales are soaring. Even if things go back to quote-unquote normal in terms of supply chain, Wood believes that gas-powered sales won't return in the same way they've done in the past. Furthermore, from an electric vehicle standpoint, the LFP battery chemistry, while cheaper, handicaps electric vehicles with less range. And so not everyone can simply use cheaper LFP batteries in their electric vehicles unless they have outstanding efficiency to still give consumers a very acceptable number of drivable miles for each vehicle charge. Tesla so far has a major advantage here, as their vehicles in many cases are 30% more efficient than the competition, meaning that they can integrate the cheaper LFP battery cells into their cars and still achieve the same range, if not more, than their competitors. This is pointed out by Cathie Wood in a recent interview by Bloomberg, when she stated that if you look at the range and power of Tesla's vehicles, most competitors are not going to be able to reach Tesla's level of performance unless they want to lose money. They may still sell vehicles based on their brands, but they won't have as good an electric car as Tesla will provide. But it doesn't stop there. Many believe that it's just a matter of time before legacy automakers that have been making cars for 100 years and know how to make cars will catch up to Tesla. But Cathie Wood throws cold water on this, showing that ARK's estimates for Tesla's capital expenditures are about to surpass companies like GM and Ford if they haven't already. That's a sign that Tesla is investing more aggressively than even these major companies and may actually widen their lead, especially as Tesla prepares to announce yet another factory location later this year. Grouping it all together, ARK Invest is expecting LFP batteries to put downward pressure on costs, but not anytime soon for auto manufacturers that haven't yet graduated to be able to use these batteries effectively. For those that believe that legacy auto will catch up to Tesla, they may be blown away by Tesla's capital expenditures surpassing that of Ford and GM. The scary part is that 100% of Tesla's investments go into EVs, whereas legacy auto still needs to support the ICE part of their business. So even though these numbers are close, Tesla is pulling far ahead in electric vehicles, while other automakers may not be investing appropriately into EVs. Currently, automakers are insulated thanks to high margins and ever-increasing prices, especially on their gas-powered vehicles. But due to demand destruction, this can quickly shift, leading to lower margins, but with unit volume not returning for ICE vehicles, but instead further shifting to EVs. Traditional auto relies heavily on gas cars and will thus see a collapse in their valuations as reality sets in. So do you think that demand destruction on ICE vehicles will further accelerate the shift to EVs? And if inflation calms down as Elon Musk is beginning to see, will Tesla soon be able to lower their prices while maintaining industry-leading margins? Please hit the like button and subscribe, we would really appreciate that. And a huge shout out to all of our patrons that help to support our channel. Your support helps us to continue to make great content. Thank you guys so much for watching.